Attention UK pensioners. Starting November 15, 2025, HMRC is changing the way they take tax from your pensions, and if you're not careful, you could see your retirement income slashed without warning. Whether it's your state pension, private pension, or flexible withdrawals, this could hit you hard, but there's a way to protect yourself. Watch closely, because I'll break down exactly what HMRC doesn't want you to miss and show you how to make sure your money stays safe. Hey, I just want to make sure you don't miss any of the important updates I share here, like this topic about HMRC and pension changes. I'll be uploading this very topic soon, so if you want to stay informed and get it first, make sure you subscribe to my channel. This channel is really just for people like you, so hit that subscribe button and join me. Starting from the 15th of November in 2025, His Majesty's Revenue and Customs is implementing a significant change that will affect millions of pensioners across the United Kingdom. And if you are receiving a state pension or any form of retirement income, this is something you absolutely need to understand, because it could have direct implications for your finances and how you manage your tax affairs. This change centers around how HMRC collects tax from pensioners, particularly those who have multiple sources of income during their retirement years. And while the government has presented this as a simplification measure, the reality is that many older people will need to take specific actions to ensure they are not caught off guard by unexpected tax bills or complications with their retirement income. To really understand what is happening here, we need to first talk about how tax collection works for pensioners in the United Kingdom, because this is something that confuses many people and the new rules build upon this existing system. When you are working and receiving a salary from an employer, your taxes are typically collected through something called pay as you earn, which most people know as pay, and this system automatically deducts the correct amount of income tax from your wages before you even receive them. However, when you reach retirement age and start receiving pension income, the situation becomes more complicated, because you might be receiving money from several different sources at once, and each of these sources needs to be taxed correctly according to your total income for the year. Many pensioners in the UK receive what is called the state pension from the government, which is a regular payment you get based on your national insurance contributions throughout your working life, and this money counts as taxable income, even though many people do not realize this fact. On top of the state pension, you might also be receiving income from a private pension that you built up through your employer during your career, or perhaps you have a personal pension that you contributed to independently over the years. Some pensioners also continue to work part-time after reaching retirement age, which adds employment income into the mix, while others might have rental income from properties they own or investment income from savings and shares. All of these different income streams need to be added together to calculate your total taxable income for the year, and HMRC needs to collect the right amount of tax based on this combined figure. The way HMRC has traditionally handled this complexity is through a system where they assign your personal tax allowance to one of your income sources, usually the largest one, and then they use tax codes to collect tax from your other income sources to make sure you pay the right total amount by the end of the tax year. Your personal allowance is the amount of income you can receive each year before you have to pay any tax at all, and for most people this stands at £12,570 for the current tax year, though this amount can vary depending on your circumstances. When you have multiple pensions, HMRC typically assigns this allowance to one pension provider, often the one paying you the most money, and then your other pensions are taxed using different codes that assume you have already used up your allowance elsewhere. This is where the major change coming on the 15th of November becomes crucial to understand, because HMRC is altering how they handle situations where pensioners have underpaid or overpaid tax during a tax year. Previously, when HMRC discovered that someone had not paid enough tax during the year, perhaps because their income changed or because their tax code was not quite right, they would often collect this underpayment by adjusting the tax code for the following year. This meant that if you owed them £500 in underpaid tax, they would change your tax code so that over the next 12 months, you would gradually pay back this amount through slightly higher deductions from your pension. This system spread the cost over time and meant that most people did not face a sudden large bill that would strain their monthly budget. However, the new rule change means that HMRC will now be able to collect underpaid tax much more quickly and directly, particularly from pensioners who have flexibly accessed their pension pots under the pension freedoms that were introduced several years ago. Under these pension freedoms, people aged 55 and over can now withdraw money from their defined contribution pension schemes in various flexible ways, rather than being required to purchase an annuity that pays a fixed income for life. You might take a lump sum withdrawal to pay for home improvements or a holiday, or you might set up a regular income drawdown arrangement where you take money out of your pension pot as you need it, leaving the rest invested to potentially grow over time. These flexible options have been very popular with retirees who want more control over their retirement savings, but they also create complications for the tax system because each withdrawal can be taxed differently depending on your circumstances at that particular moment. When you take money out of your pension flexibly, the pension provider needs to deduct income tax before they give you the money, but they often do not have complete information about your other income sources or your overall tax situation. This means they sometimes use an emergency tax code that deducts too much tax from your withdrawal, which you then need to claim back from HMRC, or occasionally they deduct too little tax, which means you end up owing money to the tax authorities later. The new rules coming into effect on the 15th of November give HMRC the power to instruct your pension provider to collect any underpaid tax directly from your future pension payments, and they can do this much more quickly than before without necessarily going through the process of adjusting your tax code gradually over a full year. What this means in practical terms is that if you have underpaid tax, perhaps because you took a large flexible withdrawal from your pension and the tax deducted at the time was not quite right, or because you had some unexpected income that pushed you into a higher tax bracket, HMRC can now tell your pension provider to take the money you owe directly from your next pension payment or payments. This could result in you receiving a significantly reduced pension payment in a particular month, which might come as an unwelcome surprise if you are not expecting it and have not budgeted for this possibility. For pensioners living on fixed incomes who carefully plan their monthly expenses around their expected pension payments, a sudden reduction could create genuine financial difficulties and might even leave some people struggling to pay their bills or afford essential items. The government and HMRC argue that this change is actually beneficial for pensioners because it helps ensure that tax debts are cleared more quickly and efficiently, preventing small underpayments from accumulating into larger debts over time. They also point out that collecting underpaid tax directly from pension payments is more straightforward than sending out tax bills that pensioners would need to pay separately, which some older people might find confusing or forget to pay on time. From the administrative perspective, this approach certainly makes tax collection more efficient for HMRC and reduces the amount of outstanding tax debt on their books. However, critics of this change worry that it places additional burden on pensioners who may already be struggling financially, particularly those who are not confident with managing complex financial matters or who do not regularly check their tax position throughout the year. So what should you actually do to protect yourself and ensure you are not caught out by this rule change? The first and most important step is to check your current tax position with HMRC to make sure you are paying the right amount of tax on all your income sources and that there are no outstanding underpayments from previous years that might trigger a collection action under these new rules. You can do this by logging into your personal tax account on the HMRC website, which gives you access to information about your tax code, your estimated income for the current year, and any tax you have underpaid or overpaid. If you are not comfortable using computers or do not have internet access, you can also telephone HMRC directly and speak to an advisor who can check your tax position for you and explain whether there are any issues you need to address. If you discover that you have underpaid tax from previous years, it would be wise to contact HMRC proactively to discuss payment arrangements before the new rules come into effect on the 15th of November. By getting in touch first, you may be able to negotiate a payment plan that spreads the cost over a longer period or makes sure the deductions from your pension are manageable within your monthly budget. HMRC is often willing to work with people who come forward voluntarily to sort out tax problems, and being proactive shows that you are taking responsibility for your tax affairs rather than trying to avoid payment. This approach gives you much more control over the situation compared to having HMRC suddenly instruct your pension provider to collect the money without warning. Another important action you should take is to review all your sources of income and make sure HMRC knows about everything you are receiving, because one of the main reasons people underpay tax is that HMRC does not have complete information about their financial situation. If you have started receiving a new pension, or if you have begun renting out a property, or if you have investment income that HMRC might not know about, you need to inform them so they can update your tax code accordingly. Failing to declare income is not only illegal but also leads to exactly the kind of tax underpayment that could trigger collection action under these new rules. Remember that HMRC has access to a great deal of information from banks, pension providers, and other financial institutions, so they will likely discover undeclared income eventually, and dealing with the situation after they find out is always more difficult and stressful than being honest from the start. For pensioners who regularly take flexible withdrawals from their pension pots, it becomes even more important to understand how these withdrawals are taxed and to keep track of your total income throughout the tax year. Each time you take money out of your pension, your provider should give you a statement showing how much tax has been deducted, and you should keep these statements carefully and review them periodically to make sure the tax treatment seems correct. If you take several small withdrawals rather than one large one, or if your income varies significantly from month to month, you are at higher risk of tax miscalculations that could result in either overpayment or underpayment. Some pensioners find it helpful to work with an accountant or financial advisor who can help them plan their pension withdrawals in a tax-efficient way and ensure they are meeting all their tax obligations correctly throughout the year. It is also worth understanding that different types of pension income are treated differently for tax purposes, which adds another layer of complexity to this situation. The state pension is always taxable income but is paid to you gross, meaning without any tax deducted, because HMRC collects the tax due on state pension by adjusting the tax code on your other income sources. Private and workplace pensions are usually paid with tax already deducted under pay, but the amount deducted depends on your tax code, which should reflect your total income picture. Annuity income is taxed like any other pension, but flexible pension withdrawals might be taxed differently, particularly if you are taking your first withdrawal or if your income has changed significantly since the last time you accessed your pension. Looking ahead beyond the 15th of November, pensioners should get into the habit of reviewing their tax position at least once or twice a year, perhaps at the start of each new tax year in April and then again around October or November. This regular checking helps you spot problems early before they grow into larger underpayments that become difficult to handle. The HMRC personal tax account makes this checking relatively straightforward for those comfortable with technology, and the information is updated regularly to reflect your current situation. If you notice that your estimated tax bill seems too high or too low compared to what you think it should be, contact HMRC immediately to discuss it rather than assuming everything will sort itself out automatically. Finally, it is important to remember that while these rule changes might seem concerning and do require your attention, they are not designed to trap pensioners or to make your life unnecessarily difficult. The fundamental principle remains that you should pay the correct amount of tax on your income, nothing more and nothing less, and HMRC has a responsibility to collect the tax that is legally due. What has changed is simply the mechanism and timing of how they collect underpaid tax from people receiving pension income. By staying informed about your tax affairs, keeping accurate records of all your income sources, and maintaining open communication with HMRC when questions or problems arise, you can navigate these changes successfully and ensure that your retirement income remains stable and predictable throughout the year. The key message for every UK pensioner is to be proactive rather than reactive, to check your position before the 15th of November arrives, and to seek help from HMRC or professional advisors if you are uncertain about any aspect of your tax situation, because taking action now will prevent unwelcome surprises in your pension payments later.